You buy a chocolate for 10 cents and tell your friend, "Tomorrow this will be worth 20 cents. Your friend gets excited and lends you 90 cents so you can buy even more chocolates. But the next day, instead of going up, the chocolate price falls to 5 cents. Now you lose your own money, and your friend's loan also sinks. This is exactly what happened in America's stock market, and this is the story of the Great Depression. The 1920s were called the Roaring Twenties. It was a time when America looked rich and full of hope. Cars filled the streets, radios and movies entertained families, and electricity spread to homes. People believed life was only going to get better. Many started thinking that the stock market was the fastest way to get rich. Buying stocks looked like owning a money machine that never stopped printing cash. Banks and brokers added fuel to this dream. Here's how it worked. Banks gave loans to brokers, and brokers then gave loans to investors. This chain made everyone feel rich. If you wanted to buy $100 worth of stocks, you only needed to pay $10 of your own money. The broker, with money borrowed from the bank, would lend you the other $90. Investors agreed to pay interest on this loan, usually 8% to 12% a year. This system was called buying on margin. At first, it looked amazing. Imagine Ram has only $10. He borrows $90 from his broker and buys $100 worth of stocks. If the stock goes up by 10%, he makes a profit of $10, doubling his money instantly. But if the stock falls by just 10%, his own $10 is gone, and he still owes the broker $90 plus interest. Now, here comes the real problem. When stock prices started to fall in late 1929, brokers called investors and said, "You must either pay more cash into your account or sell your stocks to cover your loan." This was called a margin call. Most investors didn't have extra money to put in because they had already borrowed too much. Many were earning only $200 a month, but had borrowed $1,000 or more. They couldn't pay interest and they couldn't add more collateral, so they were forced to sell their stocks at very low prices. When thousands of investors sold at once, stock prices crashed even faster. Brokers who had borrowed money from banks also could not pay the banks back. Soon, banks themselves ran out of money. This chain reaction, from investor to broker to bank, pulled down the entire financial system. And then came October 1929. The fear had been building, but in October, it exploded. Big investors began selling stocks because they felt the market was overvalued. Ordinary people saw this and panicked too. Everyone tried to sell at the same time, but no one wanted to buy. On October 24th, 1929, Black Thursday, the market fell 11%. People crowded outside the New York Stock Exchange, shouting and crying. Newspapers reported chaos. On Black Monday, October 28th, the market dropped another 13%. On Black Tuesday, October 29th, it crashed again by almost 12%. In just a few days, billions of dollars were wiped out. The crash didn't stop there. For the next 3 years, stock prices kept falling. By 1932, the market had lost 90% of its value. The Dow Jones Index, which had once reached 381, fell all the way to just 41. Imagine a whole town where everyone tries to sell their chocolate bars at once. At first, the price falls a little, but soon everyone is desperate, and the price drops until the chocolate is almost worthless. That's what happened to stocks. The disaster spread everywhere. Banks had given loans to brokers, but when brokers couldn't get money back from investors, the banks themselves collapsed. over 9,000 banks shut down. Investors who had borrowed heavily lost their life savings, houses, and farms. Ordinary people suffered the most. Factories closed because nobody was buying goods anymore. Businesses failed, and unemployment reached 25%. That meant 1 in every 4 Americans had no job. Farmers couldn't sell their wheat or corn. It lay rotting in the fields, while city families stood in long lines just to get a piece of bread. A family that once earned $50 a month suddenly had no income at all. Many had to live in tents or tiny shacks made from scrap wood and metal. The Great Depression was not just an American tragedy, it became a global crisis. America had been lending money and trading with many countries. When America fell, the rest of the world fell too. Global trade dropped by almost 65%. Germany, Britain, and France all faced mass unemployment and hunger. That is why this period is remembered not just as a depression, but the Great Depression. It began in October 1929, reached its worst point in 1932 and 1933, and dragged on for nearly a decade. Hope returned in 1933, when Franklin D. Roosevelt became president. He introduced the New Deal. This plan brought new laws to protect banks so people could trust them again. The government launched public projects to give jobs, building roads, bridges, and schools. Farmers received support to stabilize their lives. By 1935, the economy started to improve, though slowly. But the full recovery came later, when World War II began in 1939. Factories reopened, not to make radios or cars, but to produce tanks, planes, and weapons. Millions of people found jobs again, industries revived, and America finally escaped the Great Depression. It was like a struggling family making new rules. One person cooked, another cleaned, another worked. By sharing responsibility, the family survived. In the same way, America rebuilt itself. The Great Depression gave the world a powerful lesson. If people become greedy and borrow too much, the risk can destroy everything. But with rules, patience, and smart planning, even the worst crisis can be overcome. The Great Depression is not only a story from the past, it remains a warning for our future. And if you enjoyed learning this important chapter of history in such a simple way, don't forget to like this video, subscribe to Scastory, and share it with your friends.